There's a trap that has caught investors for generations. Not just beginners, experienced investors too, smart people who should have known better. It's not a bad company, it's not a scam, it's not poor timing. The trap is simple, buying a great company at a terrible price. Think back to 2000, Cisco, one of the best tech companies in the world. Everyone said it was a sure thing. If you bought at the peak, you lost 80%. 25 years later, it still hasn't fully recovered. Intel, same story. Dominant company, incredible technology. Bought at the wrong price, you're still underwater today. The company wasn't the problem, the price was. And right now I'm seeing the exact same setup with the most talked about stock in the market, Palantir. You've probably heard about it. Maybe your grandchildren have mentioned it. Maybe your financial advisor has brought it up. It's everywhere. They're calling it the next Microsoft, the next Nvidia, a once-in-a-generation opportunity. But here's what I've noticed. Everyone's talking about the potential. Almost nobody's talking about the price. So I sat down and did what I've always done. I looked at the numbers, the actual valuation, the fundamentals. What I found gave me serious pause. And I think you deserve to see it too. In this video, I'm going to walk you through everything. No hype, no pressure, no agenda, just the math. You've worked too hard for your money to make decisions based on hype. You deserve the full picture. I'm the stat guy. Let's take a careful look at this together. Okay, first things first. I need to be honest about why people are so excited about this stock. Because the bull case for Palantir is genuinely compelling. And if I just ignored it, I wouldn't be giving you the full picture. So let's talk about what's actually good here. Number one, and this is the big one, Palantir is a legitimate AI company, not a company that slapped AI onto their marketing materials in 2023 to pump their stock price. They've been building data analytics and artificial intelligence infrastructure for over 20 years, and they started working with government agencies, intelligence services, military operations. These are not easy clients to win. And the fact that they have deep relationships with the Department of Defense, with the CIA, with NATO allies, that's a genuine competitive moat. Number two, their commercial business is actually growing. For years, the criticism of Palantir was that they were too dependent on government contracts. They couldn't crack the commercial market. Well, that narrative has changed. Their US commercial revenue has been growing at over 50% year over year. They're landing deals with major enterprises. Companies like BP, Airbus, Ferrari are using their platforms. That's real progress. Number three, they're actually profitable now. For years, Palantir was burning cash. Stock-based compensation was out of control, but they've turned a corner. They've posted several consecutive quarters of GAAP profitability. Cash flow is positive. That's not nothing. A lot of high-growth tech companies can't say the same. Number four, the AI tailwind is real. We're in the early innings of what could be one of the biggest technology shifts in human history. And Palantir's AIP platform, their artificial intelligence platform, is getting serious traction. The demos are impressive, the use cases are real. And if enterprises continue to adopt AI at the rate we're seeing, Palantir is positioned to benefit. So look, I get it. I understand why people are excited. I understand why this stock has gone from $7 to over $100 in the span of 2 years. I understand why retail investors are piling in. The story is compelling. But here's where my brain starts asking questions that I don't hear other people asking. Because there's a difference between a great company and a great investment. And what I've learned over the years, sometimes the hard way, is that even the best companies in the world can be terrible investments if you buy them at the wrong price. And that's where my concerns begin. All right, so let's get into the actual analysis. And I'm going to break this down into 4 specific concerns that I have. These aren't opinions. These are based on the numbers that anyone can verify. Concern. Number 1, the valuation is historically extreme. Let's talk about what you're actually paying when you buy Palantir at current prices. Right now, Palantir is trading at roughly 200 times earnings. Let me put that in perspective. The S&P 500 average PE ratio is around 20 to 25. So Palantir is trading at 8 to 10 times the average valuation of the market. Now, some people will say, but stat guy, you can't use PE ratios for growth stocks. That's for boring companies like Walmart and Target. Okay, fine. Let's look at other metrics. Price to sales ratio. Palantir is trading at over 65 times sales. For comparison, Nvidia at its most expensive was around 40 times sales. Microsoft trades at about 12 times sales. Even the most expensive AI companies rarely exceed 30 times sales. Price to free cash flow. Palantir is trading at over 300 times free cash flow. That means if you bought the entire company today, it would take you 300 years of current free cash flow generation to earn back your investment. Obviously, the hope is that free cash flow will grow dramatically. But that's a lot of hope priced into a stock. Let me show you what this means practically. For Palantir to deliver a reasonable return from here, say 15% per year over the next 5 years, the company would need to roughly triple its earnings while maintaining this premium valuation. If the valuation compresses even slightly, which it historically always does for maturing companies, the returns get much worse. The math is just hard at these levels. Concern number 2, the growth rate doesn't justify the premium. Here's something that I find strange. Palantir is valued like a company growing 100% year over year, but that's not actually what's happening. Total revenue growth for Palantir has been running in the 20-30% range. Now that's solid growth. That's good. But it's not hyper growth. It's not what you would expect from a company valued at 200 times earnings. Compare that to Nvidia, which was growing revenue at 100%, 200%, even 300% year over year during its big run. Compare that to Tesla in its hypergrowth phase. Compare that to Amazon in the early 2000s. The growth rate is good, but it's not exceptional, and the valuation is treating it like it's exceptional. Now, people will point to the US commercial segment, which is growing at 50-60%, and that is impressive, but it's still a relatively small portion of total revenue. Government contracts still make up the majority of the business, and government revenue growth has been much slower in the low teens. When I look at a company, I want to see the valuation justified by the actual performance. And right now, I see a mismatch. Concern number 3, stock-based compensation is still a problem. This is something that a lot of retail investors overlook because it doesn't show up in the numbers that most people look at. Palantir pays a significant portion of its employee compensation in stock, and while this has improved, it's still diluting shareholders at a meaningful rate. Over the past year, Palantir's share count has increased by about 5 to 6%. That means even if the company's value stays flat, your ownership stake is shrinking. You're being diluted. Now the company will tell you they're buying back shares to offset this. But when I look at the actual numbers, the buybacks haven't fully offset the dilution. Net dilution is still positive. This is a hidden cost that most people don't factor in. If you're getting diluted 5% per year, you need the stock to go up 5% just to break even. Add that on top of an already expensive valuation, and the hurdle gets even higher. Concern number 4, insider selling has been significant. This one bothers me more than the others, if I'm being honest. Over the past 12 months, there have been substantial insider sales at Palantir. CEO Alex Karp has sold hundreds of millions of dollars worth of stock. Other executives have been selling as well. Now look, I understand that insiders need to diversify. I understand that stock sales are often pre-planned. I'm not suggesting anything nefarious. But here's my simple question. If this is a generational opportunity, if this stock is going to $500, $1,000, why are the people who know the company best selling so aggressively? I always pay attention to what insiders do, not what they say. And right now, what they're doing is selling. Okay, so beyond the specific concerns about Palantir, there's a bigger issue that I want to talk about. And this is something I think about with every investment I make. It's called opportunity cost. Every dollar you put into Palantir is a dollar you can't put somewhere else. And right now, I see opportunities that I think offer better risk-adjusted returns. Let me give you an example. Right now, you can buy the S&P 500 at a PE ratio of about 22. That gives you exposure to 500 of the best companies in America, including all the AI winners, with a valuation that's in line with historical averages. Or you can buy Palantir at 200 times earnings, betting that one company will outperform the entire market by enough to justify a 10x valuation premium. That's a big bet. And statistically, most stocks that trade at extreme valuations underperform the market over the following 5 to 10 years. Not because they're bad companies, but because the expectations priced in are just too high. I can also find individual companies right now trading at reasonable valuations with strong growth profiles. Companies that Wall Street isn't hyping because they don't have the AI buzzword attached to them. Companies that might not make exciting YouTube videos, but might actually make you more money. When I think about where to put my capital, I'm always asking myself, what's the expected return here and what are the alternatives? And right now, for me, the alternatives look better than Palantir at 100 plus. Okay, so I've told you what I'm not doing, but I think it's only fair to tell you what I am doing, because it's easy to be a critic. It's harder to actually have a plan. So here's my current approach. First, I'm maintaining my core position in broad market index funds. This is not exciting, I know. It doesn't make for great YouTube content. But time and time again, the data shows that most investors, including professional fund managers, fail to beat the S&P 500 over long periods of time. I'm not arrogant enough to think I'm smarter than the market. So about 60% of my portfolio is just in low-cost index funds. Second, I'm looking at undervalued quality. There are genuinely good companies right now trading at reasonable valuations because they're out of favor or because they don't have the AI narrative attached to them. I've been looking at companies in sectors that are boring but profitable. Companies with strong balance sheets, consistent free cash flow, and valuations that actually make mathematical sense. Third, I'm keeping cash available. This is going to sound crazy to some of you, but I actually have about 15% of my portfolio in cash right now, not because I'm trying to time the market, but because I want to have dry powder when opportunities emerge. Historically, the best buying opportunities come when everyone else is panicking, and you can't buy the dip if you have no cash. Fourth, I'm being patient. And this might be the hardest part. When everyone around you is making money on a stock, when your coworker who started investing 6 months ago is up 200% on Palantir, it's really hard to sit on the sidelines. But I've learned that FOMO is the most expensive emotion in investing. Some of my biggest mistakes have come from chasing stocks that had already made their big moves. I'd rather miss out on some gains than buy something I don't understand at a price I can't justify. Now, I want to be clear about something before I wrap up, because I don't want you to walk away from this video with the wrong impression. I could be completely wrong about Palantir. The company could continue executing. The AI platform could become even more dominant. Revenue growth could accelerate. The valuation that looks crazy today could look reasonable in hindsight if the company 5x its earnings over the next few years. That is absolutely possible. I'm not saying it's not. What I am saying is that based on my analysis, based on the numbers, based on my personal risk tolerance, this is not a bet I want to make with my money right now. Investing is not about being right or wrong on one stock. It's about making decisions with positive expected value over many decisions. It's about process, not outcomes. Sometimes the best process leads to bad outcomes in the short term. Sometimes people who make terrible decisions get lucky and make a lot of money. That's just how probability works. All I can control is my process. And my process says, this doesn't make sense for me right now. If you've done your own analysis and you've come to a different conclusion, that's completely valid. You might be right. You might see something I'm missing. Investing would be boring if everyone agreed on everything. The point of this video isn't to tell you what to do. It's to show you how I think. Because I believe that thinking independently, doing your own analysis, and being willing to disagree with the crowd is more valuable than any stock pick. So that's my honest take on the stock everyone's buying right now. To summarize, Palantir is a real company with real technology and real growth. I'm not disputing that. But the valuation is historically extreme. The growth rate doesn't fully justify the premium. Stock-based compensation continues to dilute shareholders. And insiders have been selling aggressively. For me, the risk-reward just isn't there at current prices. Could I be wrong? Absolutely. And if I am, I'll come back to this video and own it. I'll tell you exactly what I missed and what I learned. Because that's how you actually get better at this. Now here's what I want you to do. First, I want you to think for yourself. Don't just take my word for it. Don't just take some other YouTuber's word for it. Do your own analysis. Look at the numbers. Form your own opinion. The best investors I know are independent thinkers, not followers. Second, if you found this video valuable, if you appreciate this kind of honest, no-hype analysis, consider subscribing to the channel. I'm trying to build something different here. No clickbait, no once-in-a-lifetime opportunity every week. Just real analysis and real talk about investing. Third, leave me a comment. Tell me if you agree or disagree. Tell me what I got wrong. Tell me what I should look at next. I read every comment, and honestly, I learn a lot from them. And finally, if you want to see my full breakdown of the stocks I'm actually buying right now, I'm putting together a video on that. So make sure you're subscribed so you don't miss it. I'm the Stack Guy. Thanks for watching, and I'll see you in the next one.